Welcome to The Explainer. Today, we're going to break down a really powerful trading strategy. It's all about how to catch those massive, explosive market moves that just seem to pop up out of nowhere. We'll get into how to spot them, how to trade them, and of course, how to manage your risk. So let's kick things off with a feeling I bet every single trader knows, that gut-wrenching frustration. You're watching something, maybe it's gold, maybe it's Bitcoin, and it's just dead. It's going sideways for days. You get bored, you look away for a second, and bam, it's up 20% and you miss the whole thing. But what if that quiet time? What if that was the signal all along? So in this explainer, we're going to turn that frustration into a real, repeatable edge. Here's the plan. We'll start with the theory behind these moves, then get into how to find them, a step-by-step playbook to trade them, how to handle the risk and psychology, and maybe most importantly, how to tell a real breakout from a fake one. Okay, let's dive right into part one. See, to trade these big moves, you first have to understand why they happen, and it all boils down to one simple idea: energy. So what is price compression really? Well, you can think of it as the market just taking a deep breath. It's a quiet period where volatility dries up and the price gets stuck in this super tight, narrow channel. It's like buyers and sellers have reached a temporary truce before the next big battle. And this right here, this is the perfect way to visualize it. It really is like a coiled spring. All that market energy isn't disappearing, it's getting stored up. And the longer and tighter that price coils, well, the more explosive the eventual release is going to be. Okay, so the theory makes perfect sense, right? But how do we actually find these coiled springs on a chart before they, spring? Well, there are a few key things to look for. These are your go-to signals. You'll literally see the price action get super quiet and go flat. One of the best visual tools for this is Bollinger Bands. When you see them squeeze or pinch together, that's a textbook sign of volatility collapsing. And keep an eye on volume. It almost always dries up right before the big move. The market is just waiting. And to put a hard number on it, one of the key rules from the source material is this: you can actually scan for assets where the daily opening prices have been stuck inside a tight 10% range for a while. This gives you a clear, quantitative way to find these squeeze setups. And here's a real pro tip. This is how you get surgical with it. You find the big setup on the daily chart. That's your confirmation of the coiled spring. But you don't actually enter there. You zoom down to a lower time frame, like a 60-minute chart, to nail your entry. This helps you get a much, much better risk to reward on the trade. All right, we've found a squeeze. It looks perfect. Now what? This is the fun part. This is the actionable step-by-step process for actually placing the trade. It really boils down to this 4-step playbook. It's simple, but you got to follow every step. First, identify that tight range. Second, and this is the hardest part, you wait. Third, you look for confirmation, like a big spike in volume. And then, and only then, do you pull the trigger with your pre-planned trade. Discipline is absolutely everything here. Now, I'm going to say this again because it is the most important rule of this whole strategy. A little spike above the range during the day means absolutely nothing. That could just be a trap. You've got to wait for that candle, whether it's the hour or the day, to officially close outside of that zone. That is your green light. That's the confirmation. Knowing the playbook is one thing. That's only half of it. The real battle is fought right between your ears. How you manage your risk and how you control your emotions, that's what separates the pros from everyone else. This table right here isn't just some nice-to-have advice. No, this is your survival guide. Your stop loss, it goes right back inside that tight range you just broke out of. That defines your risk to the penny. And because these breakouts can be wild, you might want to trade a little smaller than usual. And have a plan to take some profits off the table. That way you lock in a win, but still give yourself a chance at a home run. And this quote, man, this just sums up the whole mental game perfectly. You have to have the patience of a saint while you're waiting for that price to coil. But the second you get your signal, that confirmed candle close, you have to act. No hesitation. It's a true test of discipline. Okay, now we have to talk about the number one problem with this strategy, the thing that trips everyone up, the dreaded fake out. How do you know when the move is for real? Well, now get this. According to the source material, the specific rules we've been talking about, especially waiting for that candle close and checking those daily opens, are designed to filter out an estimated 82% of those false breakouts. That's a huge edge right there. And let's put these side by side because it makes it so obvious. A real breakout closes with power, way outside the range, and it does it on a big surge of volume. Then you see immediate follow-through. A fakeout, on the other hand, it just kind of pokes its head out, usually on weak volume, and then gets slammed right back down into the range. Your two best friends here are the candle's close and the volume. They're your truth detectors. Okay, so let's wrap this all up. If you remember nothing else, remember these 5 things. First, compression is a coiled spring building energy. Second, use your tools to find that squeeze. Third, and most importantly, wait for that confirmed candle close. Fourth, always, always, always manage your risk. And finally, use volume to tell you if the move is the real deal. And that leaves us with one final question. And it's a question that really gets to the heart of your personal trading style. Are you the type of trader who tries to jump in on that initial price poke, hoping for a better price, but risking a fake out? Or are you willing to wait for the full confirmation of a candle close, even if it means a slightly worse entry price? It's that classic trade-off, aggression versus confirmation. Something to think about.